Welcome, everyone, to another edition of In the Divine, where we're bringing all things crypto together with Algo. Hello, people. Hopefully that you're in a good mood because right now I'm not going to give you great news. I told you this channel is going to give you news that I think that you need, news that is going to be important to hold your bags. So today, what I'm doing is giving you kind of a heads up um, to brace for any pain that you may see going on in the market. I'm not going to give you financial advice because I'm not a financial advisor. Everybody knows that's not what I do. But I will bring to your attention a couple of factors that I think that is important for you to see and understand for when you see some of the ups and downs in the market for the next couple of months to a year, because this is just our reality. It's different from the other markets that you were in when you were in the bear market at the other point in time back in 2018 and all those other times. It's a different time. A lot of different factors are in effect. And there's two things that I want to bring to your mind right now. All right. And one, I need you to check this out because I want you to hear this. And this is basically about China. Now, why am I telling you about China? Because China affects our market more than you think. If there are things doing bad, it affects our market. Just like if the economy in U.S. does bad, it affects other people's market. China's the second biggest market in the world. So I want you to hear this.
And it's a very complex web of financial interactions. Developers are in trouble, financiers are in trouble. And of course, what I think manages worries for the government is that there's a lot of savings wrapped up in that market. So they're trying to really take some pressure off that property market and, of course, take some pressure off the broader economy.
That is Judo Bank economic advisor Warren Hogan commenting on the imploding Chinese property market. In his words, developers are in trouble, financiers are in trouble, and plenty of worries for the Chinese government. After the pandemic in 2019, it seems China is passing through yet another dramatic movement. And this time in an unexpected sector, which is the real estate sector. Subsequently, after years of booming, astounding expansion, and accumulating billions, China's real estate industry is suddenly retreating. Why this event seems to be a huge topic for economists in China and other countries as they are keeping a tight eye on the market right now is because China has a huge impact on the world, and also real estate has been one of the key drivers of the second largest economy in the world. Property accounted for over 70% of the nation's household wealth and 30 to 40% of bank loan books, while land sales generated 30 to 40% of local government revenue. And in China, there are 2 trillion yuan, $296 billion, in total mortgages at stalled Chinese developments, according to experts at GF Securities Company and Deutsche Bank AG. Many are asking questions about if this is truly happening and why this is happening. Welcome back to.
So this first part is just letting you know global economy affects your bag. Just like when we were going through the housing crisis here in America, where it caused such a recession where things went down and everything was depressed. And all this time we spent, actually it recovered in probably about 3 years, but it affected other markets around the world because Lehman Brothers and all those other big companies, they pretty much defaulted and they needed to be bailed out because if they went down, the economy was going to suffer. So this is what China is going through right now. Do you bail out all these companies that is like underwater with their obligations to the point where you're going to blow up your own economy. What you're going to do is right now is they are a communist country. They don't work like us. So their government has a complete total sway over over the economy. But with that, the blame being able to change because you lose the faith of your citizens if you do it in the wrong way. And no matter how big or how rigid you are, if you lose the faith of your people, then your economy is not going to work, because you have to trust that you're going to get paid. You have to trust that you're going to be able to get what you've paid for. And right now, China's trying to figure that out without killing their markets. So, yeah, when you see things happening in the market and you don't see things pumping, there's a lot of stuff in the pipeline that's really clogging it up, and you may not see the effects of why didn't this pump or why isn't liquidity, because a lot of big players are in the Chinese market, and if they're in the position to be leveraged in that market and it's unclear what that market is about to do or about to go, there's going to be a tie-up with any whale or any economic things that these companies may be doing, because right now China is just unsure, it's just uncertain. And for the economy to really roar like it's supposed to, it needs certainty. Businesses know that they need to put this here because the economy is working like this. So there's a second part of this that I wanted to make sure you heard, and it was the Fed Chairman Powell, where he comes and gives so many of us the good news of what they're doing with the market.
As the ever-changing structure of the economy and the challenges of conducting monetary policy under high uncertainty. Today, my remarks will be shorter, my focus narrower, and my message more direct. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those who are least able to bear them. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation.
So, with that, the good news is that the Fed chairman understands we're in a bad situation. The bad news is that he's going to make it worse, because he knows that in the long run, we need to be at a lower inflation cycle than 8.5 or 8.7 or the 10 point that we really are at. Which means that they're going to keep raising rates. They got to slow down the economy to bring demand and supply into balance. And right now it's out of whack, and everybody knows this. And this is some of the more truthful words that you will hear from a politician. I don't consider Fed chairman not political. They are political animals, because they got to cover the president or whatever actions that, whatever party's in office, they got to cover their butt. So I want you to understand, if you don't see algo pumping, if you don't see the market operating like it should, that you're like, this should be a pump, you're not going to really get a pump, because there's too many things that are uncertain for the major money to move, for major things to actually continue to grow, because the Fed chairman just said, we're going to put the brakes on the growth of the market. And even though he understands that that's going to bring pain to those who are least able to take pain, he says it's still needed because the markets has to be in a position to be better balanced, because that's the only tool in the Fed's tool belt to really have an effect on the market, is to raise interest rates, because that's what he's inferring. So any bank person, any hedge fund manager, even any VC, any person who's a whale that's in your banking and in your crypto, heard these words, and they are going to lock up their money so tight. They're going to put their money in any hard asset that they can, and they're going to wait it out because they can. They can. And I want you to be understanding of what the realities of the crypto market is. It's not going away. People will panic. People without an understanding of what's really going on will say crypto is dead, Bitcoin's going to zero, Algo's going to zero. There's going to be fear all in the thing. And I just want you to understand, you don't have to be fearful if you know where everything's going. He said that he's gonna, the market has to be balanced. So that takes time. So that means if you're looking to moonshot, it necessarily won't be this year. It won't be next year unless it's the end of next year, unless some things shake out. You have to look at the market. Everything is not just about it just should. There's an organic process to the way the markets work, to have people really on board and have things really work and spark out the way it's supposed to. So this is the video, and it's not, like I said, it's not algo centric, but it is economic and bag centric. So leave a comment down, subscribe and like. Tell me what you think of the whole thing. And this is Sam Houston, hoping that your bags in tomorrow is going to be heavier than your bags are today. And I'm out.